Howdy, who all my stock market gamblers? Welcome today. I'm Tall Mike. I'm so glad you're here. Well, what do we got going on in the markets today? It's Fed Day. Fed Day. The Fed's going to come out. They're going to raise a quarter basis point. That's going to move the markets, right? Well, the market's doing right now. Well, the Dow's up about 10 points. NASDAQ's down about 60 points. Kind of flat, just kind of waiting, kind of hanging out for the Fed. Fed announcement will come and the market will have a reaction. And then Jerome Powell will talk and he'll probably have a different reaction. It's just how it works, but it's going to be a market mover. Very exciting. All right, so what we got going on right now is we got earnings season, right? Like, for example, Google just came out. They beat the numbers. They went up. Microsoft came out, missed the numbers a little bit. They went down. So earnings season is typically a very strong time of the year, a very strong time of each quarter, right? All right, it comes out 4 times a year, earnings, and it's for about 5 weeks in a quarter. Now, if you just play those 5 weeks, you can actually beat the S&P 500. Just be in the market for those 5 weeks, take your money out, put it back in, take your money out, put it back in, you will beat the S&P. But here's when you don't beat the S&P. When the S&P is trading above 10% above the 200-day moving average. So if you're more than 10% above the 200-day moving average, typically earnings season sends the market lower. And that's where we're at right now. We're well above 10% above the 200-day moving average. And this earnings season will probably send the markets lower. We'll see how that all plays out. Just fascinating things to watch, but we got Jerome coming out in about an hour to raise a quarter basis points. Markets will take off from there. All right, so what I want to talk a little bit today is about, well, a news story that's not really a news story. I can't find it in the news today. But anyways, PacWest is being bought out by the Bank of California. So now they call it a buyout, but I think it's really another failed bank. Everybody was looking at PacWest to be the next bank to go down. Now, PacWest is the 49th largest bank in the United States, the 49th largest, right? And they're getting bought out by Bank of California, the 135th largest. So they're getting bought out by a much smaller bank. Kind of interesting to me. Anyways, I think this is more of a bailout. They calling it a merger. They're calling it a buyout. But I think PacWest was another failed bank, but they want to cover this up. Now, PacWest, they were at about $44 billion in assets under management. And now what's interesting is the Bank of California, they're only about $10 billion in assets under management, but yet they're acquiring PacWest. Now, PacWest, what they were invested in, they get the depositors, money comes in, right? People come and deposit their money, and then they take that money and they put it out in the form of loans. And the loans that PacWest had, just some of them, they had about $4 billion in commercial, about $5 or $6 billion in multifamily housing, and about $15 billion in residential loans. Now, all of those loans were made when the rates were basically 0%. But now the Fed's raised rates up to about 5.5% they'll be at today. And what happens to the value of those assets? So they kept the depositors' money came in, they put them out in the form of loans, but those loan values have come way down in value. And PacWest has been selling some of these off. They sold a couple billion of these loans off to a Canadian insurance company, and they sold them at a massive discount. Okay, so they basically don't have the money of the depositors when they come in to ask for their money back. And they had a little run on the banks. The run on the banks are still going on. A lot of people don't like talking about this, but they lost about 10% of their deposits in the first quarter because of the run on the banks. Now, a lot of the regional banks are having runs on the banks, and they're having these runs for a good reason, because they own most of the commercial loans. About 70% of commercial loans are held by the regional banks. I think you're going to start seeing the banks starting to topple over one after another after another. See these bank runs, well, the banks, they don't have your money because they lent it out. So you went and gave them your money. They lend it out in loans, and they lend it out when the loans were at 0%, and now they raised it to 5%. So the assets that, their loan values have gone way down. So they have about 50% of your money if they were to sell all of their assets to get your money back in. Now, if that was your bank, you wouldn't be very happy to come in and to say, well, we can only give you 50% of your money back. But I'm FDI insured, Mike. I got FDI insurance, FDIC, I guess it is. I got that a little wrong there. But anyways, well, the FDIC doesn't have your money either. They have about 1% of your money. So the banks have already lost half of your money, and the FDIC, now they have 1%. Now, a lot of people don't want me talking about this because I don't want to be the one that causes the run on the banks, but I think the banks are very unstable right now. I think they're losing money. A lot of, for example, PacWest lost a couple $100 million in the first quarter, and finally they got someone to take them over. Now everybody says, but Mike, the banks are fine. Look at their stock values. Look at the stock market. They're going up. The stocks are going up. And that's all true. They're going up, right? So it's got to be okay. And we should just ignore the runs that the banks are having. But when a bank is having a run on the bank, what do they typically do? Do they typically want to make new loans? Do they want to loan money out? Look at, they need to get money in now. They're paying you 5% right now. Some banks are paying 5.5% just to get you to deposit money with them. They're starving for money because they've already lost half of the money you gave them the first time. So they want you to bring them more money. Okay, and maybe you will. All right, so they're paying 5%. It's really hard for banks to make money right now. They're losing money. Now, I know the big banks, but Mike, JP Morgan, they just came out with earnings, record earnings. Bank of America, record earnings. Citi, record earnings. All the big banks, they're going to be getting a benefit from this because a lot of people are pulling the money out of the regionals and putting it into the big banks because they know the big banks are going to get bailed out by the government if they go under. And I do think they're going to have a run on these big banks also. So I don't think the banks are that stable. But let's talk about the real estate market now, in particular the housing market, how it all affects this. Well, every one of you's locked in at that 2.8%. That 2.8%, I got 2.8. Isn't that incredible? That's a low rate. That's a low rate, right? All right. And you have equity, right? Because you put money down on your house, and the house, maybe you bought it 5 years ago, and maybe it went up if you bought it in the last year. Kind of down a little bit. You're already losing some of that equity. But you got that equity in your house. Now, what people don't understand is the reason the housing market has gone so far up since, let's call it 1980 to 2022. All right, the market has gone up, basically straight up, right? Now, it has gone up because it was able to refinance itself. Anytime someone needed money, they just refinanced their house, pulled out some money to live on, and they could watch their house values continue to go up. It was financed by debt. But right now what's happening is that you're locked in at this 2.8% in your forever home. You're going to live there forever because you have 2.8%. But okay, so you're locked in and you got equity, right? But how do you get the money? How do you tap the equity to support your lifestyle? You see, you have your forever home right now, right? You got your forever home, but it's like you got this moment right now. Oh, crap, I can't afford my forever home. The bills, they keep going up. Inflation keeps going up. Look, at inflation's not done. We got oil hitting $80 a barrel. Now, the reason inflation's gone down, now, if you believe that 3% number, I don't believe that 3% number at all. I don't believe there's 3% inflation. I don't believe there's 3% unemployment. I got friends out there, they're so unemployed, they're looking for jobs. They're getting layoffs still coming. I'm in Silicon Valley with these high-tech people. The layoffs are still running rampant. I mean, they don't talk about that in the mainstream media, all these layoffs. Oh, you can't say that stuff because it's scary, right? There's these layoffs. And inflation, we got to say it's only 3%. We'll take out food. We'll take out energy. We won't count any of the stuff that you buy because the stuff that you buy is going up higher and higher. But anyways, we reduced the oil reserves, right? We sold our oil reserves to bring inflation down, and we got it down there. That number they can call 3%, right? But we don't have any oil anymore. Now oil's at $80, probably going to 100. That's just my opinion. A lot of you think oil's going to crash down to 30. Maybe it will. I think it's going higher. I think inflation's going to come back. I think the second wave is getting ready to come back. I think food prices are going to come back higher. Look at the grains. Look at the grains. Just look at them now. If you want to look at something going up, look at the grain market going up, oil market going up. Okay, well, that's going to bring back this inflation. A lot of people can't handle inflation. You see, the consumer is tapped out. They're tapped out. They're just waving the white flag. We don't have any money. We need more stimulus money. Could you print some more money and send it to us? Can we get some universal basic income coming? We need some more money. We don't have any money. Look at people are drowning in debt, right? People are drowning in debt. There's 1.6 million people right now behind on their mortgage. Now they have equity. They can sell that house and eventually they're going to put those houses on the market and there's going to be a flood of them coming onto the market, which is going to bring prices down. But there's 1.6 million of them already behind in their mortgage. All right. Well, how's the credit card business doing? Credit card business is booming, right? Now, just 2 years ago, we'll call it 2021. 2021, we were about $700 billion on credit cards. Well, right now, we're over $1 trillion on credit cards. Just in 2 years, we've gone up almost 50% from 700 billion to now over $1 trillion. All right, maybe not quite 50%. Let's call it 40% increase on the credit cards. But anyways, so credit cards at a record high. You know what's at a record low? Savings. People don't have any money to save because they can't afford their lifestyle. They can't afford the cost of living. Look at 62% of people in the United States are living paycheck to paycheck. In that, you get a poll, all right, so 70% say they're under financial duress already. This is the good times. This is where we got the booming economy. This is where we got the booming stock market. These are the good times, and 70% of people are reporting financial distress. I mean, 48% of the United States population doesn't have $400 saved up for an emergency. But yet we think the housing market's going to continue to go on. Our local analyst, Damon, he came out and says, hey, Mike, did you see it? Did you see it? The housing data came out. It's better than expected, so we're going to go to the moon. I don't see it that way. You see, people don't have a way to get money. They don't have a way to get the equity out. They want to go get a HELOC loan. Good luck with that. You're paying about 10%. You know what a credit card loan's running right now? The average is about 24%. People are tapped out. Now, what happens when they're tapped out? Well, let's look at car repossessions. 15 to 20,000 cars a day are being repoed, right? I mean, that's a $1.5 trillion market. Now, who's holding all of that paper? Well, these banks, and these banks are not making loans. People go and apply for these loans. They're getting turned down. They're getting turned down. 1 out of every 5 people now that applies to refinance their house. Well, I think if you got to refinance your house, you're in a lot of trouble, but you're getting turned away. They won't give you the money. They won't give you a loan. Apply for new credit card line of credits, 1 in 5 getting turned away. 20% of the people getting turned away for new car loans. Now, here's something fascinating to me. Okay, also 1 out of every 5 car loans is over $1,000 a month. Their payment is over $1,000 a month. 1 out of every 5 car loans. Now, here's a little secret for you. Look at, if you can't afford to pay cash for your car, you surely cannot afford $1,000 a month car loan payment. So this is just ludicrous. It's going to come to an end, right? Now, what happens when people are tapped out? They have one choice. They can't refinance their house because they're locked in at that 2.8%. If they refinancing now is up at 7.5%, 8% for do a refi right now. And that's 7.5%. You got good credit, 8% if you don't. That's pretty high up there, right? Because you're going to lose your 2.8. You can't finance your life at 2.8. How are you going to finance your life at 7%? You're not going to be able to. So what's the other alternative that's going to happen? Market. They're going to dump these houses onto the market. What happens when they dump the houses onto the market? There's going to be millions of them coming on. 1.6 million people are delinquent on their mortgage right now. That's only going to get worse from here. I'm telling you, people cannot afford their lifestyle. They're tapped out. Now, but Mike, we got this government. They're going to come and they're going to print money and they're going to send it to us just like they did in the pandemic. You'll see, Mike, they're going to give us more money. We're going to get out of this mess. We're going to keep having our lifestyle. Look at our lifestyles funded by debt. Debt is record high for the government, record high for corporations, record high for individuals. People cannot afford this anymore. They can't afford their lifestyle. Something's going to break. What's going to break? It's going to be the housing market. They're going to be dumping their houses onto the market because they cannot afford their forever home, even at 2.8%. And it's going to be sad when they refi, get that 7% loan. They're going to be dumping that house so fast. And that's just what's going to happen. So what happens to your equity when the prices go down? Well, your equity goes away. No more home equity. Right now, we got equity envy out there. Look at it. I got 200,000 in equity. Well, Zillow says I got 250. Redfin says I got 300,000. We got this equity envy thing. We got this rate envy, people bragging about that 2.8 that they're locked in at, and the next guy's got it 2.9 and 3. It's equity envy. It's rate envy. It's out there. There's a lot of envy. You talk to me a year from now, it's going to be sad. It's going to be real sad. We'll see if I'm right. I hope I'm wrong. I want to be wrong. Everybody thinks I want to be right. I don't want to be right. I don't want to see this total collapse. I don't want to see it. I hope they can push it out for another 10 or 20 years. Do I believe they can? No, I don't even think they can push it out for one more year, but that's just my take. Just my take. Ask Damon, our analyst. He'll tell you everything's fine, and maybe it is. I want to believe you, Damon. Damon, I love you, man. You're doing good work. Doing good work. Keep it up. Anyways, everybody, it's a Wednesday. We got the Fed coming out, quarter point raise coming. Markets will start moving when that happens. That will be where the market move is coming. All right, so get out there, enjoy the day. Let's see what happens with the Fed. Give me the thumbs up. Why not? I'm Tall Mike. Hit the subscribe button. I want to talk to you on Friday so we can talk about the move that's coming in the markets from the Fed announcement today. Get out there. Bye-bye now.